Hey everyone, welcome back to the channel. Today, we're diving deep into one of the biggest players in the market, Amazon, ticker symbol AMZN. If you're looking to understand whether this tech and retail giant is still a buy in 2026, or if recent concerns about their spending are a red flag, you're in the right place. This is a comprehensive stock analysis where we'll break down everything from revenue streams to financials, valuation, and even intrinsic value. So, grab a coffee, hit that like button, and let's get started. Amazon needs no introduction, but let's set the stage. We're talking about a company that's not just an e-commerce juggernaut, but also a leader in cloud computing, streaming, and now artificial intelligence. However, recent news has rattled investors with a massive $200 billion capital expenditure plan for 2026 and a stock sell-off after their latest earnings. Today, we're going to unpack all of this, where Amazon stands, where it's headed, and whether this dip is a buying opportunity or a warning sign. Stick with me as we analyze every angle of this behemoth. Let's start with a quick overview of Amazon.com Inc. Founded in 1994 and headquartered in Seattle, Washington, Amazon has grown from an online bookstore to a global powerhouse. Under CEO Andy Jassy, the company operates in multiple segments: e-commerce through its online and physical stores, cloud computing via Amazon Web Services, AWS, subscription services like Prime, and advertising. They've got a workforce of over 1.56 million employees and operate across North America, Europe, and Asia. Their mission? To be Earth's most customer-centric company. But with a market cap of over $2.2 trillion and a stock price sitting at $210.32 as of this analysis, the question is, are they still a growth story, or are cracks starting to show? Let's dig deeper. Now let's talk numbers, specifically Amazon's revenue. For fiscal year 2024, Amazon reported a staggering $637.9 billion in total revenue, up from $574.8 billion in 2023. That's a solid 11% year-over-year growth, showing they're still scaling despite their massive size. Breaking it down by segment, North America remains the largest contributor at $438 billion, or about 69% of total revenue. Internationally, they pulled in $93.8 billion, with key markets like Germany, $40.9 billion, the UK, $37.9 billion, and Japan, $27.4 billion, driving growth. Looking at product categories, online stores brought in $247 billion, but the real stars are AWS at $107.6 billion and third-party seller services at $156.1 billion. AWS, their cloud computing arm, is a cash cow with high margins, while third-party sellers show how dominant their marketplace has become. Advertising services are also booming at $56.2 billion, and subscription services like Prime hit $44.4 billion. Physical stores, while smaller at $21.2 billion, are still a piece of the puzzle. The takeaway? Amazon's revenue is diversified, but AWS and third-party services are increasingly critical to their growth story. Are they leaning too heavily on these high-growth areas? We'll circle back to that. Moving on to earnings, Amazon's latest report for Q4 2025 had some mixed signals. While full-year 2025 revenue hit $716.9 billion, up 12% from 2024, they missed EPS estimates, which spooked the market. Net income for 2025 was a robust $77.7 billion, translating to an EPS of $7.29, a significant jump from $5.66 in 2024. However, recent news from Zacks and Fool highlights investor concerns over management's aggressive spending plans. More on that in a bit. The key takeaway from earnings is that while top-line growth and profitability are strong, Wall Street is jittery about future cash flow given the CapEx outlook. Let's see what management had to say. Unfortunately, I don't have the specific Q4 2025 earnings call transcript summary to share today. However, based on recent news, CEO Andy Jassy has been vocal about the company's $200 billion CapEx plan for 2026, particularly for AI and data centers. As reported by Fool and YouTube clips, Jassy is confident that this investment will yield strong returns on invested capital. He emphasized Amazon's long-term vision, especially in AI, with their $8 billion investment in Anthropic now valued at over $60 billion, a seven-fold increase. Management's tone seems optimistic, but the market isn't fully buying it yet, with concerns about free cash flow potentially turning negative this year, as noted by CNBC. This aggressive spending is a double-edged sword. Let's see how it plays out in the financials. All right, let's dive into Amazon's financial statements for a clearer picture. Starting with the income statement, gross profit for 2025 was $360.5 billion, with a gross margin of about 50%, showing they're maintaining efficiency despite scale. Operating income jumped to $79.9 billion, and net income, as mentioned, hit $77.7 billion. That's a net profit margin of 11.1%, up from 9.3% in 2024. Impressive for a company of this size. Looking at the balance sheet, total assets as of 2025 stand at $818 billion, up from $624.9 billion in 2024, driven by investments in infrastructure and tech. Cash and equivalents are at $86.8 billion, giving them a decent liquidity buffer. However, total liabilities are $407 billion, with a debt-to-equity ratio of 0.37, which isn't alarming but worth monitoring given the CapEx plans. Current ratio is just above 1 at 1.01, signaling they can cover short-term obligations, but it's tight. Finally, the cash flow statement reveals a potential concern. While operating cash flow in 2025 was a strong $139.5 billion, free cash flow was only $7.7 billion after a massive $131.8 billion in capital expenditures. Compare that to 2024's free cash flow of $32.9 billion, and you see why investors are nervous. If CapEx hits $200 billion in 2026 as projected, free cash flow could indeed go negative, as CNBC warned. ROE is solid at 23.6%, and ROIC is 11.8%, showing they're still generating value, but the cash flow squeeze is a red flag for the near term. Let's talk valuation. At a current price of $210.32, Amazon's trailing PE rates 33.4, which is high but not outrageous for a growth stock. Their price-to-sales ratio is 3.7, reflecting the market's willingness to pay a premium for their revenue growth. Looking at forward PE estimates, analysts project a ratio of 30.1 for 2026, dropping to 24.5 by 2027, and even 19.4 by 2028. This suggests the market expects earnings to catch up with the stock price over time. Compared to the specialty retail industry average PE of 55.1, Amazon looks relatively cheaper, but keep in mind their diversified business model sets them apart from pure retailers. Enterprise value for 2025 is $2.63 trillion, factoring in debt, which is hefty. Recent articles from Zacks note that post-earnings, Amazon is trading near its lowest PE in a decade, hinting at a potential bargain if you believe in their long-term story. However, with a free cash flow yield of just 0.41%, the valuation assumes a lot of future growth to justify current prices. Is it overvalued, or is this dip a buying opportunity? Let's explore further. Now, let's break down Amazon's SWOT analysis: strengths, weaknesses, opportunities, and threats. Strengths. First, Amazon's revenue growth is undeniable. $760.9 billion in 2025 shows they're still scaling. AWS remains a dominant force in cloud computing, and their diversified revenue streams from advertising to subscriptions provide stability. Their brand power and logistics network are unmatched, with over 1.56 million employees fueling operations. Plus, their Anthropic investment soaring to $60.6 billion signals they're ahead in the AI race. Weaknesses. On the flip side, thin free cash flow is a concern. With only $7.7 billion in 2025 and projections of negative FCF in 2026 due to $200 billion in CapEx, there's risk if investments don't pay off quickly. Margins in e-commerce are also lower compared to AWS, and their current ratio of 1.01 shows limited short-term liquidity. Opportunities. The AI boom is a massive tailwind. Amazon's investments in data centers and partnerships like Anthropic position them as a leader. Expansion in international markets, especially in emerging economies, and growth in advertising, already at $56.2 billion, are huge opportunities. Plus, their foray into new areas like live NFL game streaming with non-traditional media partners could open new revenue streams. Threats. Competition is fierce. Microsoft and Google in cloud computing, Walmart in retail, and regulatory scrutiny globally are constant headaches. The $200 billion CapEx plan also risks investor confidence if returns lag, and macroeconomic factors like inflation or recession could hit consumer spending on their platform. Recent stock performance, down 12.3% in the past week, shows the market's unease. Overall, Amazon's strengths and opportunities are compelling, but the capex gamble and cash flow concerns are real risks to watch. Let's take a look at Amazon's recent stock performance. As of early 2026, the stock is at $210.32, but it's taken a beating lately. Over the past week, it's down 12.3%, and over the past month, it's off by 12.7%. The 3-month performance shows a decline of 13.5%, and year-to-date, it's down 11.9%. However, zoom out to 5 years, and it's still up 26.6%, reflecting long-term strength. Technically, as noted by FX Empire, the stock recently tested major support levels, including long-term Fibonacci retracements and moving averages. There's a potential bottom forming, with resistance ahead. Short-term, I'd watch for a bounce if it holds above key support around $200, but a break below could signal more downside. Compared to the consumer cyclical sector, which is up 3.1% over the past year, Amazon is lagging, likely due to capex fears. Long-term investors might see this dip as an entry point, but near-term volatility is likely. Now let's estimate Amazon's intrinsic value to see if the current price makes sense. I've run a discounted cash flow DCF model based on their historical growth rates, projected earnings, and free cash flow trends. I'm assuming a conservative revenue growth rate of 10% annually for the next 5 years, tapering to 5% thereafter, given their size. I've factored in a discount rate of 8%, reflecting their beta of 1.39 and market risk. CapEx is a wild card, so I've modeled scenarios with FCF recovering post-2026 as AI investments pay off. I've also considered their operating margin expanding slightly to 12% over time as AWS scales. Let's see the results. After crunching the numbers, my DCF model suggests an intrinsic value for Amazon of approximately $245 per share. That's about 16% above the current price of $210.32, indicating the stock might be undervalued despite recent sell-offs. However, this assumes their capex yields strong returns by 2027 and FCF rebounds. In a bear case with slower growth or prolonged negative FCF, the value drops to around $180. In a bull case, with AI driving outsized growth, it could hit $300. Given the uncertainty, I'm leaning toward the base case of $245 as a fair value, suggesting there's upside potential for long-term investors willing to weather near-term volatility.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our Stock's Intrinsic Value Calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.